Video Trade. This is Don Kaufman. September 8, 2021. 28 minutes to go to the cash close here with a bit of sell-side activity in the S&Ps, a bit more sell-side activity inside of the NASDAQ, bringing us directly to the question, is big tech overdue for a big fall? We're going to answer that and much more here on this evening's video. All right, first and foremost, so you're looking at the S&P futures. Again, there's about 27 minutes to go to the cash close. Volume is extraordinarily heavy relative to what we've seen as of late. In fact, I'm actually going to start with this because I think it's a critical aspect that is often overlooked in markets on a day-to-day basis. So listen, the S&Ps, you're not seeing anything spellbinding going on today, right? They had some decent range. We did touch down to 44.92, but they're moving like, 0.2% at this point. It's not like a lot of sell-side activity. Nevertheless, the volume, this really resonates with me. It's substantially higher than any of the recent trading sessions. All right, so people are coming back from summer. It's vacation is over. It's back to work, possibly. But I'm going to tell you right now, there are signs of some heavy positioning going on, not only in the S&Ps, but volatility as well. And that was what was actually drawing me into this conclusion that big tech really is actually overdue for quite some sell-side activity, which I'm going to show you here momentarily. So let's get to work on that front. As I said, volume has really picked up in the S&Ps, but before you go too far, there is a roll that's going to start to really kick in. And when I say the roll, that's going to be rolling, the S&P futures from SEP to DEES. And that is going to add to the volume here. So this is the last day we're going to get a really clean take on volume. So you see, again, S&P volume happens to be a little bit elevated on this particular front. Again, indicative, lots of hedging activity and or positioning. All right, let's actually move forward. The next thing I want to take a quick glance at just happens to be the NASDAQ as a whole. It has completely and utterly stalled out. Now, there's nothing like wildly quantitative about what I'm about to say, but effectively you have 6 days where the NASDAQ literally has gone dead on us. I mean, it is completely flat. If you are a market technician, it's doji star after doji star. It's a couple doji candles in here. But that isn't really what caught my attention. And I think that this is the critical part expressly relating to NASDAQ. Now, I don't want to make this a bearish connotation. I'm going to bring the bearish connotation in a moment. What I want to display to you, and I think that's critically important, is that we understand, the differential between realized volatility, better known as historical volatility. Historical volatility is the annualized standard deviation of past stock price movement. It's actual price movement in the marketplace. And then we're going to look at things like implied volatility. And this, to me, this cannot be overstated. And I've pointed this out a lot. Now, let's start here in the options chain. And the options chain, as we come closer to the closing bell, in the options chain, just take a look at the September 10th expiration, right? So this is going to happen on Friday. I know it's Wednesday, but this is going to happen on Friday. And right here, you're actually pricing net, like the average implied volatility in here is sitting around 14.5%. Good. All right. So it's an implication of risk moving forward. All right. So what are the cues actually doing? For that, we're going to have to go a little bit in depth. The first thing we want to do, let's get rid of this volume subgraph. So we come over here to this little sprocket, click on equities, click on show volume subgraph, hit apply, hit OK. So we got rid of the volume subgraph. Then we come over studies, go add study, down to volatility studies, bring up historical volatility. So bring up historical volatility. But then I want you to right click on historical volatility, go to edit it, knock it down from 20 days. Just knock it down to the near term. Like, what is this little monkey averaging in terms of historical volatility over the last 5 days? Hit apply, hit OK. Here is your answer. Okay, this is the biggest area of concern in the marketplace right now, at least for me, and something I've pointed out just incessantly. Okay, If you remember back a couple of weeks ago, I was pointing out the exact same thing. We got an explosion of movement in the marketplace. And again, this is not meant to be a bearish connotation for the marketplace. I'll come to that in just a moment. What we have here, okay, is realized volatility. It's basically, what does it say right there? It's, it's 0.049, which basically breaks down to 5%. So that's 5%, and that's HV, historical volatility, over the last, over the last 5 days. And you can see even earlier today, I actually caught this and it was 3%, but neither here nor there. So it's actually come up a little bit because, well, the NASDAQ got a little bit more active. So we're up to 5% historical volatility. Remember, what did I show you a moment ago? What I showed you a moment ago is that implied volatility. Let's just get crazy. Let's put it at about 14%, okay, is IV. Look at the differential. Right? Now, I'm not here saying that, this has to mirror this. No, but there ain't no free lunch in this business. One of the first things you will learn, okay, in the business is there's no free lunch. Do you think that a product is going to move at a rate of 5% when they're actually paying you upwards of 14% in terms of the risk metric? And the answer is absolutely, unequivocally not. There's got to be a reason this is at 14%. Get ready to rumble. Now, there is absolutely, unequivocally no directional bias to what I just mentioned. The directional bias, okay, that comes by means of, well, so then I started looking deeply into the monsters of tech. The monsters of tech is our conglomerate symbol. It's Apple, it's Amazon, it's Facebook, it's Google, it's Microsoft, and it's compiled and compressed into one, nice little symbol over here. And what I've kind of noticed is not only did it go flat, but when you start looking at the individual products in here, some of them that are absolutely critical are absolutely waning. All right, here's Microsoft after hitting the upper edge of the expected move last week. It's been falling a little bit. Take a look at Apple. Absolutely blistering move to the upside in Apple. It reversed today. But there are a handful of stocks in the monsters of tech that are, okay, moving to the upside and in effect literally covering the tracks of some broader weakness in technology in general. One of those happens to be Apple, but Apple reversed today. The other one happens to be none other than, of course, Amazon. Has been an absolute tear to the upside. Amazon today, okay, if you will, I know it's only up 0.3%. It's actually reversed quite considerably on the trading day. It's only up 0.3%, but Amazon is enough to kind of counteract some of the action. You're seeing some fairly hideous weakness inside of, Facebook, which is well off some of the session lows. You're seeing a little bit of weakness inside of Google, okay? These are underlyings, though. When you start looking at them on a year-to-date basis, Google's up 66% on a year-to-date basis. Facebook, 40%, okay? Any one of the monsters of tech that have been stellar in terms of performance are actually seeing no performance, okay? Underlyings like Amazon, which have seen terrible performance on a year-to-date basis versus the marketplace, have been flying to the upside. Amazon being one of them. Amazon, okay, literally like 2 weeks ago was flat on the year. It's now up 10%. Apple, you got to go back more than a few weeks, but in Apple, it was down, okay, in like mid-June on the year. It was literally down mid-June. Right here, okay, later into June, it was basically flat on the year. It's now up 20%. And now we're even seeing that reverse. Okay, so that's not me. I'm not much of a market technician. However, here is some more pivotal evidence. One thing I really picked up on today is the NASDAQ. All right, we're going to go look at the NASDAQ futures. The NASDAQ futures started pretty much out of the gate, a little bit soft, and then there was some fairly violent selling. While that was actually going on, we noticed some pretty heavy activity in the VVIX. That's the volatility index. And this was actually corresponding some of the sell side activity in the NASDAQ, which was surprising to me. The VVIX actually took off to the upside. And what that's indicative of, again, is some heavy activity, specifically in VIX options. And we were very surprised. Like, people are looking at the VIX, are like, well, the VIX is flat. Of course the VIX is flat. But traders have actually been going in there buying, all right, VIX options today. In fact, the volatility in the VIX is now sky high. I mean, we're just trading at a 116 VVIX out there. There was heavy activity, though, on the call side of thing in the VIX. Early on, the VIX was actually doing 3, almost 4 times the norm, okay, at that point in the day. Things kind of calmed off. The call sizzle is still high kind of relative to the put sizzle, which is again is indicative of a lot of call activity over here. But the call activity, meaning that traders were rushing in and buying calls in the VIX, that call activity absolutely unequivocally correspond to the selling inside of the NASDAQ. So at this point, okay, I'm just going to go ahead and put everybody like on a little bit of notice. Just the next 2 days, coming into Thursday and Friday, to watch the NASDAQ very carefully. Twofold. Number one, the NASDAQ is absolutely poised for a very substantial move, right? Today it's moving at a rate of 0.5%. It's down $2. But if you start looking at the expected move, just between right now and Friday expiration, it's looking to almost hit another $4 move specifically to the QQQ. So again, there's a lot more volatility than kind of meets the eye. Again, that's not really, as I said, that's not really a bearish connotation because that movement is implied to the upside or the downside. The bearish side of this equation is it's just that, you know, again, the top performers when it comes to what I term big tech or what I call the monsters of tech have actually been underperforming. Okay, they look extraordinarily heavy. NVIDIA is another one that has just been flying as of late, but started to see some pretty substantial selling before kind of rebounding. There again, I think you've been kind of put on notice by the NASDAQ that number one, expect some fairly tumultuous volatility, and number two, okay, market feels extraordinarily heavy. Last thing I want to point out this evening, and I point out each and every Wednesday, okay, we are right in the middle of where we should be in terms of SPX overall movement. So we have a 4-day trading week. The expected move, okay, for the entire week is approximately plus or minus $50, plus or minus $50. So what this amounts to, we sold off, okay, we did not touch the lower edge of the expected move. If you're kind of curious, what is the lower edge of the expected move? Right here, okay, you're at about 44, let's call it 44.85 would be the lower edge of the expected move. We touched down to 44.93, basically ripped a little bit higher. This, okay, down here, again, at that 44.85, it's a critical level. We hit it overnight, we hit it tomorrow, okay, be watching that one. What, okay, could break this market's back? Right now, it's all eyes on tech. You know that financials have been whacked back recently, okay? All eyes, again, are on big technology stocks. All eyes, of course, have got to be on this 44.85 in terms of the SPX. We break through it. Things get downright wild. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.